Hello, my name is Valerie Serrani of International Risk Consultants here in New York, and I'm here today with John Salinger, who is the recently retired president of AIG's Global Trade Credit and Political Risk Division. Welcome to the 11th edition of IRC's video series. I'm Valerie Serrani with International Risk Consultants here in New York. I'm sitting here with John Salinger, who is the recently retired president of AIG's Global Trade Credit and Political Risk Division. Thank you, John, for being with us here today.
Valerie, thank you, and thanks to IRC for doing this.
Well, John, you were with AIG for over 28 years. Prior to that, you were with Chase Manhattan Bank for another 12 years. You've accepted assignments in New York, London, Hong Kong, Lagos, Nigeria. So you've obviously gone through an era of rapid growth and expansion in the industry, which is pretty safe to say that no one else has experienced more or seen more than you. So since you joined the industry, which has happened to be at the height of the Latin American debt crisis in 1983, can you just explain what it was like during that time?
Sure, Valerie. I joined AIG in June of 1985, and what had happened between the onset of the debt crisis and my joining AIG was that a lot of sovereign debt risks had migrated from the banking sector into the political risk and trade credit insurance markets. And I can tell you that that experience practically crushed the industry. Within a month of my joining, we incurred major claims. Claims in Brazil, Mexico, Venezuela, Argentina, Peru, Jamaica, Nicaragua, Guatemala, Nigeria, Cameroon, Iraq, Iran, Indonesia, and that's just a few of them. And it was over $1 billion in claims, which was a lot of money back then. It took us 5 years of working through those claims and putting recovery programs in place. We were fortunate to recover more than 50% of everything that we paid, but the impact on our business was severe. For example, in 1983, AIG could write a contract frustration risk of $125 million, and it had a lot of reinsurance support. By 1986, that shrank to $6 million as our maximum capacity, and there was virtually no reinsurance available.
John, could you reflect upon some of the key developments that have impacted the industry, the trade credit and political risk insurance industry, since all of this?
Well, I'd say that we've grown up, and I'd cite four things. First, I'd talk about the maturity of the underwriting markets. Back in 1985, 86, 87, many people thought that political risk insurance could not be underwritten by the private sector, and the government sector was the only thing that really counted. Second, I'd cite the professionalism of the broking market. Back in the mid-'80s, we had brokers coming in, presenting us risks, and the only thing they knew about the risk was what the commission should be. And you just don't get that now. And I would certainly put IRC very high up on the list of professional brokers that we have today. Thirdly, there's a different relationship now between the public sector and the private sector underwriting markets. These markets were completely different and separate back in the 80s and the 90s, and they competed fiercely with one another. And that has completely changed today. We collaborate, we both are in the Berne Union, and often we're able to work with ECA members to create a win-win-win solution for the market. And finally, I think the markets, both the brokers and the underwriters, have contributed to the development of some exciting new product offerings.
You mentioned some of the products, concepts, and producers in the industry that really impacted the industry. But what about the underwriting talent and leadership, especially as it relates to the so-called American style of underwriting, otherwise known as excess of loss, which is characterized by underwriting above a deductible and giving discretionary authority to the insured?
Well, AIG was the one who pioneered the excess of loss approach, and that was actually before my time. But it was seen in its day as a very, very radical approach to taking credit risk. And it was widely disparaged by the traditional underwriters who would go around saying that it wasn't a good product and that the underwriters would never pay a discretionary credit limit loss because they would find something wrong with what had happened. That changed completely. That perception changed completely in 2008 after the traditional underwriters at the height of the financial crisis precipitously and arbitrarily canceled hundreds of thousands of credit limits. And that action put credit insurance on the front page of the Financial Times for the first time ever. And in contrast to that is the excess of loss, which went through that period. Claims were incurred, claims were paid without any difficulty. And it proved that it was a superior insurance product.
So what impact has technology had on the industry this century, and what developments does it suggest are next for the industry?
The impact of technology on the industry has been profound. AIG started working on credit algorithms as far back as 1990, and that effort has continued to today. For example, it allows us to have some programs in the UK where a team of 8 underwriters can manage about a dozen policies for factoring companies and invoice discounters that has 70,000 buyer limits. 70,000 buyer limits and only a team of 8 underwriters. That can only be done with technology. Internally, there's been a great impact as well, because instead of having a bunch of credit files, paper files all around the world, AIG now has a credit file database where all of the credit information on buyers is stored and can be accessed by any underwriter any place in the world. Technology has enabled us to connect directly with clients who can come directly into our underwriting system, apply for limits, manage their policies that way. Applying that kind of technology also enables us to create programs that facilitate financing, and not just bank financing, which has always been part of what the industry does, but also financing in the capital markets. Next year, I know AIG is working on a program that it will introduce in the UK that will be targeted at small and medium-sized companies. It'll be an insurance policy with embedded technology, and it won't surprise me to see that product being offered with zero deductible and non-cancelable credit limits, and that will be a breakthrough offering.
You mentioned the Berne Union in one of your responses to a previous question. AIGU were the first private sector insurer that was allowed into the group. So what is the Berne Union? What purpose does it serve? And what was your role in it?
The Berne Union is the association of the world's major political risk and export credit insurers. It includes mostly government-backed ECAs. But we thought at AIG that it would be a good organization for us to join because it focuses on best underwriting practices. And I approached the Secretary General at the time in 1996 and suggested it. It took the Berne Union 3 years to deal with our application for membership, but in 1999 we were finally admitted as the first fully private sector member to ever be invited to join the Berne Union. At the meetings, we focus on collaboration and understanding what others are doing to try to create situations that are win-win-win for everybody involved. Personally, I was the chairman of the short-term credit committee, which is the largest part of the organization. I was on the management committee of the Berne Union for 7 or 8 years, and I also served as vice president of the Berne Union.
What do you see for the industry going forward, and what unfolding developments do you think our audience may not yet perceive but are surely inevitable?
I think there are going to be 4 things that are going to be increasingly important. First of all, I think the excess of loss product is going to become the dominant product in the market. It's not today. The market today is about $8 billion in premium worldwide, and excess of loss is only about $500 million. And I think in the future, the excess of loss is going to grow much more quickly than the traditional product, which is seen as a good service, but not necessarily as good insurance. Secondly, you're going to increasingly see technology be applied to the product, and there will be increased connectivity between the client, the broker, the underwriter to see and share information and to control exposure. Technology may also be combined with programs that are going to facilitate financing both in the banking and even the capital markets. And finally, I think that infrastructure development that's required around the world is going to give rise to project finance risk underwriting, which will entail long-term project risks with the insurers covering both commercial as well as political risks.
Well, thank you, John, again today for coming in and sharing your thoughts with us. It is unfortunate that we have to, carry on without you by our side. To the broker community, you were for many years one of the few, fixed beacons to really, guide the industry. So again, you will be missed. Thank you for what you've done for the industry and certainly for IRC. We really, of course, appreciate it.
And thank you to all your colleagues at IRC. It's been a pleasure to be in this industry, and it's been a pleasure to work with IRC, who I have seen grow from an organization operating out of Jack's Garage in Columbus to a global organization. It's quite an accomplishment, and you're to be congratulated.
Thank you.